I'm going to be the Professor's Grade, and on this video, I want to talk about Canada's relationship between inflation and interest rate. So I'll just share my screen and give you guys a sneak peek into what I'm talking about. So yeah, basically, what I have here is Canada's inflation and interest rates from 1987 until 2023. Okay, pretty simple graph. If you look at something interesting, Canada's inflation rate, which is labeled by the red graph, red line, and the interest rate is by the blue line, right? One thing that's very interesting is that the inflation rate has been below the interest rate until 2011-ish. So 2011 was the first time Canada's inflation rate went above the bond interest rate. That's a big deal because people talk about how the middle class in Canada got poorer, blah, blah, blah. But this is not a phenomenon that started under Trudeau. Trudeau actually got elected in 2015. So this started well before Trudeau came into power. And this is what the inflation interest rate's looking right now. So if you're trying to predict the future, you got to look at the past. That's usually the best metric to look at. I mean, currently, obviously, the inflation rate is at numbers close to 1990s level, just below 1990s level, right? And the last time this steep increase in inflation rate happened around 2010, just after the new money was printed after the housing crash in USA, which also flooded other Western currencies as well, right? And how did that go about? So the last time the inflation rate increased at such a rapid pace is in around 2010. And yeah, I can't take the data before 2010 because before 2010, inflation has been below interest rates. So it was a completely different environment. But yeah, after 2010 is the current environment we have been living in, where the net real return on Canadian bonds, which is interest rate minus inflation rate, has been negative since 2011, which means basically Canadian banks have been paying you to borrow money. It's really that simple. Okay, when the inflation rate is higher than interest rate, the Canadian government is paying you to borrow money. And yeah, why the Canadian government is so generous to give you free money? Well, because there's no such thing as free money, and they didn't find any other way to stimulate the economy but to give people free money. And giving people free money is a dangerous thing, like I mentioned in my previous videos, because the rich usually end up with most of the free money because they have assets that they can pour their money into, and they are connected to the big institution where the free money comes into. It's very simple. If I'm a government and I have to give out free money to stimulate my economy, I have two guys. One guy is a middle class income job guy who has a job, waging, no excess savings, doesn't know how to deploy capital, doesn't know how to manage big businesses. And then I have another guy, rich guy, connected to big banks, has deployed a lot of assets and capital, has a lot of businesses. Who will I give the free money to stimulate the economy? Obviously, the rich guy. So yeah, ever since 2011, the riches have been getting richer. And okay, so in 2010, inflation rose not as steeply as right now, but it rose significantly at a significant rate. How did the interest rate react? Well, I mean, it increased gradually and then it stabilized. When did it stabilize? When the inflation started dropping. Then the interest rate stabilized, and inflation for a minor 2015 area was below interest rates. So you had a very small moment in 2015 where you were getting good returns on your bonds, a real positive return. And what happened then? Inflation picked up again. They had to hammer down the interest rate. Boom, boom, boom. Inflation went down after the COVID hit. And then after lockdowns were over, it spiked up again. So if this history gives us any idea what the future holds, what we can expect is for inflation to go down and interest rates will be dropped to a level and then stabilized. And then you'll have the interest rate drop significantly. Once the inflation rate drops and stabilizes into a range, likely around 2%. Then once the interest rate starts dropping, the inflation rate will pick up again. And basically, there will be another recession and the inflation rate will drop. And so for the next few months, what we can expect, because the inflation rate has been dropping in the last few months in Canada. So in the next few months, we can expect a stabilization of interest rates. Yes, there will be a few cuts, but then it will be stabilized to a certain level, probably around 3 to 3.5%. And then when the inflation rate starts to drop significantly, they might decide to drop the interest rates further. But yeah, so basically we can expect inflation rate to come down in the next few months, a stabilization of the interest rate, likely above the previous 2% level. And yeah, what's interesting about this graph is that look at the 1990s. You had inflation at 6%, 5%. You had interest rate at 13%. So your net return was 8% on a bond. Wow. Fast forward to today, like for example, during COVID, inflation was 2%, interest rate was 1%. So your net return was minus 1%. So you went from 8% positive return in the 1990s on your Canadian government bond to negative real return today. No wonder people are putting money in stocks and crypto. And the bandwidth between interest rate and inflation just kept getting thinner and thinner until it flipped the other way. And this flip is the dangerous part because this is where the devaluation started, this massive devaluation of the currency. And yeah, so in the next few months, expect the inflation rate to come down significantly in Canada. Expect a few more interest rate cuts, but then a stabilization of the interest rate before significant more cuts. Then again, inflation rate picking up. And by the time the inflation rate picks up, then you'll have a recession. And then you'll have again massive more 0% interest rates. So the question is, when will be the next Canadian recession? Well, I mean, if you look at history, once the inflation rates drop significantly, then what you have is, so once the inflation rate will drop significantly in the next few months, it will rise up again. before the recession comes in. So what does that look like in real life? So as the inflation rate goes down and interest rate stabilizes, rents and mortgage payments will still remain high. And then when the inflation rate picks up again, that's when the bank mortgage defaults start up, and that's when the recession comes in. So that's basically what the scenario is going to look like. So yeah, it's an interesting curve. I mean, just look at how it changed over the years, right? You have this huge gap between inflation and interest rate in the 90s. The gap kept getting thinner and thinner, and today you're left with over flip. Right? Yeah, it's interesting. So yeah, that's it for this video. We'll come back with another one very soon. Until then, peace.